This is where the problem is. People buy a stock, but they expect to be right all the time. What is breakout trading? Now, when we get into the markets, the first commonsensical thing which we always think is buy low, sell high. Now, when we look at breakout trading, it goes to the other side of it. It says buy high, sell higher. Sell low, sell lower. In Gujarati, as a trader, we say vadhare vadhare levanu, ghatade ghatade vechwanu. In the same way, the logic is something like Newton's first law of motion. An object in motion can continue to stay in that motion till the time there is an external force stopping it. So in the same way, when we look at breakout trading, we take a breakout and we ride the trend till the time the trend does not bend. So now when we look at breakout trading strategies, the essential element is that a stock or an index is at times range bound or has taken out some specific supports, resistances, and you buy on that breakouts. So you're basically expecting that this breakout move should continue into much bigger moves. Now, an example in front of you, a very simple chart. There's a resistance zone where the stock has been hitting multiple times and then it breaks out. So you would expect this trend to continue. That is what we call as breakout. The opposite of it is selling the breakdown, wherein multiple times the stock or the index has found support at the same prices and then it breaks. You would expect the trend to continue on the downside. So how to trade a breakout? So let us put it down into steps. The first step is look for stocks and indices which are trading in a very tight range. The volatility is contracting. Then the next point is you look out for important swing highs and swing lows. With those swing highs and swing lows, either you will be able to make a trend line which tells you the direction of the trend and where the trend is moving up and when the trend changes. The other thing is try to identify supports and resistances. So in a lot of cases, you'll just have same price points where the stock is taking resistance. Now, once you've established a breakout point and a breakdown point, you wait. The third step is to wait for the price action to change. So you can create price alerts which is there on Dhan Broking, which is there on all the apps which are there. So you can create a price alert in terms of, say, a stock is at 100, you have a breakout point at 106. So you can create a price alert saying 106 happens, you get a notification. Now this is for case people, those who are not tracking the markets through the day. Once you've got the alert that the stock or the index has broken out, look for trading in the same trend. So for example, the stock has broken out on the upside, you want to take a buy position and you want to ride onto it. So once that is done, you initiate a trade, keep a stop loss and ride onto the position. So that is how breakout trading is. Identify, make the trend lines, wait for your price breakout, and once it is done, take a trade. What are the simple types of breakout patterns? So the first simple and the classical one is what we call as the horizontal pattern, which is where there is an established price support or a resistance which has been there for quite some time. If I were to explain it in a very simple example, back in 2010 to 2014, the Nifty had a top in 6300 in 2010, it was the top in 2013, it was the top in 2014. So I have a clear demarcation of 6300, 6400 as a resistance. Once it crosses 6400, it's a breakout. So that is a horizontal price breakout, which is very purely price based. You're not using any chart patterns. The second one is you're using trend line breakouts. Now this is where you just have a trend line. It's not necessary to be part of any pattern. The trend line tells you every time the stock tends to bounce back from this area and that stock price breaks the trend line. That is a confirmation of a trend line breakdown. So you use trend line breakouts to find entry strategies accordingly. The third one is you look at technical analysis chart patterns, which is where you look at various chart patterns like cup and handles, head and shoulders, triangles, channels. When the stock price breaks out of that pattern, you initiate a trade in the direction. The next step which comes into it is confirmation of breakouts. Now, generally many a times the stock may just make a little bit of a dash above the breakout point and just stay there. So how do you look out for confirmations? So back in the day when technical analysis started, the initial books tell you wait for a 3-day closing about the breakout points. Now that was at a time where trading was not as frequent. Now there is a trade in microseconds. So no more do we wait for 3 days for the breakout to play. You can actually initiate it at the close of the day or even in the day if there is a volume confirmation. So even if you take a trade without the confirmations, it's only going to reduce your hit rate. It may not change your, say, returns in a big way, but confirmations make you size up better. So the next part is you wait for a price breakout. Maybe if you want to be a little more safe, you wait for the closing of the stock price, or you just initiate if there is a lot of volumes. Now, why do we look at volumes? A volume confirmation tells you there is demand after the breakout point. There are more buyers wanting to buy at a higher price. So volume confirmation gives you a higher chances of the breakout playing out. The next strategy in a breakout trading is to look out for retest of a breakout. Now, this is a little difficult at times. Say for example, you have multiple tops at 100. The stock breaks out, goes to 115, 110, and then again comes back to 100, 103 levels. Now that is a price point which was the earlier breakout, should ideally act as a support. So when you try to buy the retracement back to the previous breakout point, we call it as a retest of a breakout. So you're buying again at 100, 105, or you've missed out the first breakout and you're buying a retest. So you buy around that area, expect a little bit of a dip below that breakout. It is not necessary it will stop at 100 itself or just stop at 102 or 98. So a percentage or 2 percentage points is normal to be breached in a retest of a breakout. Now, retest of a breakout generally should have lower volume. So the price should have moved up on higher volume, say from 100 to 110. The fall from 110 to 102 should be on lower volumes. That indicates that it's a slow fall. The trend is still up. And then again, when it starts reversing from 100 to 115, the volume start increasing. That's a confirmation the trend is again restarting. Now we go to the last part of this breakout trading, which actually is a worry for a lot of people, which is called as failed breakouts. Now, the problem with a failed breakout is, say the stock has broken out above 100, it goes to 105 and then falls to 60. So when I say 60, it suddenly hits your brains that the stock has fallen so much. But the fact is, when you are in a failed breakout, if you are a disciplined trader, it is only a stop loss hit. Maybe you had a stop loss at 95 or at 90. If you wait till 60, it is your mistake, not the analysis mistake or the way to trade. If you do not have stop losses, a failed breakout will hurt you real bad. So a stop loss is to get you out of a failed breakout which fails terribly. Now, how can we reduce failed breakouts? So there are 2-3 things which you can take care of. The first thing, as I said, volumes are very important. Much more important in the case like India, where it's a very concentrated market. So when the breakout happens, the volume should ideally be more than the last 1 week average or the last day itself. So if you have a 2x, 3x volume jump up on the day of breakout, it generally increases your chances of the breakout playing out. The second is market volatility. Now this is where you have to understand the trend, right? So if you're in a strong uptrend, if the Nifty is in a strong uptrend, the mid-cap indices are in a strong uptrend, your chances of the breakouts working is much higher. But in a sideways trending markets, it may be a little lower. But in a downward trending markets, your upward breakouts will have a higher tendency to not work. So the second part is, if you're with the market trend, your chances of a breakout is much higher. The last one is, there are times where there could be unfortunate news which could come out of nowhere. For example, today we keep getting MSCI changes, you get a FDA problem. Now this you cannot help. Now there are certain things which are out of your control. So only thing is, a failed breakout is a stop loss hit. All you can try to do is reduce your failed breakouts by looking at such confirmations of volume and market trend. Now let us take some examples of breakouts. Now the chart in front of you is for a company called Lemon Tree Hotels. Now if you look at it, it's a nice triangle formation. There are 3 to 4 bottoms on the lower end. There are 3 tops on the upper end. Now look at it. When the price breaks out above that 80 point, the volumes are 2x and 3x. That tells you a confirmation that the breakout is confirmed with volume. So the price is also broken out. The volumes is also given a confirmation. Now in this case, targets are generally the size of the triangle, which is where it is shown by dotted lines. So you wait for that price target to come in. Now another example in front of you is a chart for phenolics cables. It's a nice cup and handle formation. Now if you look at it, around the handle point, there is a lot of contraction of range. It starts getting into a tighter and tighter range. Now look at it. Once the breakout happens, just see the change in volumes. The volumes have gone up 5x, 10x to the general daily volumes. That gives you a much larger confirmation when there are huge volumes on the breakout. Look at it. The targets are the size of the handle and the cup. Now look at this case. The stock has gone up from 560, 600 all the way to 900, finishing all the targets which were there on the pattern. Another example, another chart in front of you is Wonderla. Now in this case, you could call it a chart pattern or you could call it a horizontal breakout also, which is there around that 250, 270 price point. Multiple times the stock has stopped here. Now again look at it. The breakout happens, the price breaks out, there is a huge candle, but the volume candle is also 3x, 5x the general volumes. And the volumes keep on increasing with the breakout. So this is a clear breakout with volumes. Now, the reason we all like breakout trading is at times there are just clean, smooth moves in a very short amount of period. Now, like we saw in Finolex cables, it went up from 600 to 800, 900 in less than a few months. In this case, a Wonderla goes up from 250 to 350 in less than 5 to 10 sessions. And that is the reason one looks at breakout trading. Huge moves in short period of time. Another example out here is a chart for Gravita, a classical cup and handle formation. Now in this case, if you notice, the first breakout happens, volumes are good, the stock moves up, then again retraces back. Now if you notice, once the stock retraces back out here, the volumes are lower on this dip. So the retest of the breakout, like you see out here, gives you the entry opportunity again, or if you've missed it, you take a fresh opportunity. Then again the stock starts trending higher. So this is what we call as buying a retest of the breakout. We've seen some of the breakout moves. Let us look at some of the stocks where the breakout did not materialize as it was expected. Now this is a chart for TFCIL. The stock gave a huge breakout, very large volumes, couple of times the large volumes were there. The stock made a breakout move from 80 to 90, made quite a few attempts, did a retest also, but finally the stock could not hold on. So what would happen in this case? You buy the stock at 80, it goes to 90, comes to 80, goes to 90. Then finally you may get stopped out at 75, 78 somewhere. But if you don't get stopped out, you do not keep a stop loss. You can lose one, the price fall on the downside. Second, you can lose a lot of time. So in this case, the stock just goes sideways for the next few months. So that is the reason you keep a stop loss. One is to save you from losses. Second is to save you from opportunity cost. Now, another example of a failed breakout. Now, this was a tough one. Now, a classical breakout, a change in volumes on that day. The single day, there is a good volume change of 3x to 5x. And the next day, the stock collapses. And from that point of time, you would have got stopped out at some point. It also breaks the lower trend line. Now, that implies it's actually now turned to a breakdown. This is where the problem is. People buy a stock, but they expect to be right all the time. Whatever strategy you do on technicals or any sort of analysis, you will not be right 100% of the time. So this is what is an example. So you have to assume that you will be right 40 to 80% of the time. 40% happens in difficult markets. 80% is not because you're right, the market is right. Another example of a retest of a trade. Now this is a breakout on Larsen and Toubro, a nice triangle breakout. Now when we look at large caps, the volumes may not be as great in a change because you have derivative volumes also. Plus large caps generally have a lot of volume generally. Now the breakout happens, does a retest, then again moves up. The retest is your another opportunity. Now like you see out here, the retest of the trend line happens, there will be a little bit of a breach, which is normal. So till the time you don't get stopped out, you remain in the trend. So after the retest, again the stock moves up into a new high. Now retest of a breakout can also be done on larger time frames. Now this is a case of IDFC First Bank. The big breakout happened at 50, 52 levels, made a breakout, and every time the stock went back to 52, it bounced back. So this is a retest of breakout where the bounces kept on happening, but a new fresh pattern eventually developed, and then again a fresh breakout happened in this case. So to sum it up, we've seen examples of a breakout trading strategy. Now the reason why we trade breakouts is so that you get in at the start of the trend, and at times when it plays out, you get a lot of returns in a very short period of time, and you always risk the same amount, or roughly, even if you use various strategies to keep your stop losses, you're trying to have a very high risk reward. Now to sum it up, what do we look out for? A range bound stock or a contraction pattern or a chart pattern. Second, make your trend lines, spot out your resistance points. Third, wait for a price confirmation. And finally, once that happens, look out for volume confirmation, and that confirms your entry into the trade. And once you're into the trade, wait for your pattern targets or ride on to the move till the time the trend continues.